Okay, I have to be honest with you. I was looking at the market data yesterday morning, and I felt like I was taking crazy pills.
Uh-oh. Why is that?
You have a company that misses on revenue. They miss on earnings per share. I mean, narrowly, but a miss is a miss.
Right.
They're facing a regulatory body that just threw their massive merger application back in their face saying, try again.
It sounds like an absolute disaster. If you just read the headlines, you'd expect the stock to be down 5, maybe 10%.
Right. And to top it all off, they're dealing with a historic winter storm that is currently freezing their entire southern network solid. Sounds like a recipe for a massive sell-off.
And yet,
Yesterday, January 27th, Union Pacific ticker UNP, it opens pre-market, takes a little dip, shakes it off like it's nothing, and closes green. Up 0.72%. Make that make sense.
it is the classic market contradiction, isn't it? But that is exactly why we do this.
So, welcome to the Deep Dive. We're Talk Tickers, and today we are unpacking that Union Pacific Q4 2025 earnings call. We need to figure out why the market shrugged off the bad news.
And we need to dig into CEO Jim Vena's very specific and, frankly, kind of blunt philosophy on feelings.
And we need to answer a question that's been bugging me. Is this railroad actually a transportation company, or is it just a really clever real estate firm in disguise?
That is a very provocative question to start with, but you're right to ask it, because before we get to any conspiracy theories, we have to look at the setup. This call was fascinating because it was less about the quarter that just finished.
And entirely about defending a narrative.
Precisamente. Management is calling it the multi-year operating story. They're leaning incredibly hard on their execution credentials.
They're basically saying, look at how well we run the trains.
Exactly, because they have this massive strategic overhang, the Norfolk Southern merger, sitting right there in plain view, and the market seems to be saying, okay, we trust the execution enough to ignore the noise.
So let's look at the noise first. Let's get the vegetables out of the way. They reported yesterday morning. What was the damage?
It wasn't a complete disaster, but it definitely wasn't a party. Adjusted EPS came in at $2.86.
And the consensus on the street was $2.87.
So they missed by a penny.
Okay, a penny miss.
Yeah.
In the grand scheme of things, that feels like a rounding error. Is that really enough to spook anyone?
A penny miss usually isn't fatal, no. But the revenue side was a bit softer, too. $6.09 billion versus a consensus of $6.12 billion.
So down about 0.5% year over year.
Yeah. But here is the metric that really caught my eye. The operating ratio.
Okay, let's pause on that for a second. For the listeners who aren't staring at railroad spreadsheets all day, operating ratio, usually when I look at a ratio or a percentage in a stock report, I want it to go up.
Yeah.
But in the rail world, it's different, right?
Exactly. It's the inverse. Operating ratio, or OR, measures your expenses as a percentage of revenue. It's how much it costs you to make a dollar.
So you want that number as low as possible.
As low as possible. Lower means more efficient.
Got it. So low is good, high is bad. Where did UNP land?
It deteriorated. It hit 60% on an adjusted basis compared to 58.1% the year prior.
Ouch. So they're becoming less efficient.
On paper, yes. Operationally, strictly looking at the financials, it looks like they slid backward. But, and this is a massive but, there was a GAAP EPS number of $3.11 floating around.
Which is way higher than the adjusted 286 we just talked about. That looks like a massive beat.
And that is where things get really interesting. That number was heavily distorted by what they called industrial park land sales. That added a massive 30-cent benefit to the bottom line.
Wait, 30 cents? That's not just selling a shed in the backyard. That is a significant chunk of change.
It is huge. Without that land sale, the earnings picture looks significantly worse.
Okay, put a pin in that.
Yeah.
We are definitely coming back to the land sales later because that smells like a strategy, not an accident.
For sure.
So you have a miss on the core business, a beat on the paper numbers thanks to selling some dirt, and an operating ratio that went the wrong way. The pre-market reaction was logical. The stock dropped to around 229.
Right, a knee-jerk reaction to the headline miss.
But then the regular session starts, and it climbs back to close at 232.55. Why? Are investors just ignoring the bad data?
They aren't ignoring it. They're looking past it. They're looking at the 2026 guidance, which we'll get to, and they are buying into what we call the service metrics narrative.
The execution story.
Essentially, the market is underwriting the idea that CEO Jim Vena can execute his way out of a soft macro environment.
Speaking of Jim Vena, let's talk about the vibe of this call. Because I've listened to a lot of earnings calls, and usually the CEOs are very polished, very guarded. Vena feels different. He dropped a line early on that I think defines his entire leadership style.
The Vena doctrine.
I like to deal with facts, not how people feel.
That was a direct quote. He said, one of my favorite sayings, when somebody tells me I think this, I tell them, tell me what the facts are.
It's blunt. It's effective. But is it? Good.
Yeah.
I mean, telling your workforce, I don't care how you feel, seems risky in 2026.
It creates a culture of extreme accountability. It removes the emotional narrative from performance reviews, and he used it to pivot immediately to the operational efficiency stats.
Right.
Because even though volumes were down and revenue was soft, the efficiency numbers were, honestly, they were kind of staggering.
Give me the highlights. What is the fact that Vena is so proud of?
Despite the volume declines, they set records. Freight car velocity was 239 daily miles per car. That's up 9%.
So the cars are moving faster, sitting lines.
Exactly. And terminal dwell, the amount of time a car sits doing nothing in a yard, was 19.8 hours. That is down about 9%.
Wow, that is a massive improvement in the rail world. Breaking the 20-hour barrier is significant.
It means the network is fluid, things aren't getting stuck.
And what about the trains themselves? I saw a stat about train length that blew my mind.
Averaging 9,729 feet.
9,700 feet. That is nearly 2 miles long.
It is.
Imagine being stuck at a railroad crossing waiting for a 2-mile-long train to pass.
Well, that is the trade-off. Longer trains mean you need fewer crews and fewer engines to move the same amount of stuff. It's hyper-efficient for the railroad.
Even if it's annoying for the town it's passing through.
And here is the kicker, and this connects back to the financial discipline. They achieved all of this while reducing workforce levels by 5%.
So fewer people, longer trains, moving faster.
That is the execution story they're selling. Vena is basically saying, look, I can't control the economy. I can't control if people aren't buying washing machines or building houses, but I can run this railroad so lean that we make money anyway.
But nature tried to throw a wrench in the gears. Vena spent a good chunk of the opening remarks talking about this massive winter storm that hit the southern region. Texas, Louisiana, Arkansas.
It was a significant event. Usually when a railroad CEO talks about weather, it's a prelude to an excuse. Oh, earnings were down because of the snow.
The dog ate my homework of the industrial sector.
Exactly. But Vena flipped it. He used the storm to flex. He said, it used to take us weeks to recover. But this time, he claimed they were already 70% recovered.
Get out of here.
And expected to be back to normal metrics by Thursday morning.
Okay, I have to challenge that. Back to normal by Thursday morning. That feels incredibly optimistic for a storm that froze the South. Is that real, or is that just CEO bluster to keep the stock price up?
It sounds optimistic, I grant you. But if you look at those velocity numbers we just discussed, the network has resilience. He has the data to back up the swagger. And the CFO, Jennifer Hammond, she backed him up on the financials.
Good.
She admitted it will add cost crews, lodging, limo services to move crews around, propane for switch heaters.
Wait, limo services?
When the trains stop, you have to move the crews by road. It gets expensive. But she was very specific. They don't foresee significant lost revenue, just delayed car loadings.
So we'll spend a little extra on propane and hotels, but we aren't losing the business. That's a confidence flex.
It is. It reinforces the facts, not feelings narrative. The feeling is it's cold and chaotic. The fact is the network is fluid.
All right, so operations are tight, but we have to address the elephant in the room. Actually, it's bigger than an elephant. It's a merger. Union Pacific trying to swallow Norfolk Southern.
The path to becoming the first transcontinental railroad.
But the regulators, the STB, the Surface Transportation Board, hit the brakes. Just before this call, news broke that the STB sent the merger filing back. They said it was incomplete. Now, for those of us who don't follow regulatory drama, who is the STB and why are they being so difficult?
The Surface Transportation Board is the federal agency that oversees rail rates and mergers. And right now, under this administration, they are incredibly skeptical of consolidation.
So sending an application back as incomplete is a power move.
It's a huge power move. In the M&A world, this can be seen as a delay tactic or, a sign of open hostility.
How did Vena handle that? Because I imagine disappointed is putting it mildly.
He played it cool. He called the request routine and a short-term blip. He insisted it won't change the timeline, which is still targeting a close in the first half of 2027.
Okay.
But there was a specific detail the STB asked for that is fascinating.
The red line request.
Yes. The STB specifically wants to know the walkaway number. They want Union Pacific to publicly disclose the financial threshold where they would abandon the deal.
Why would they ask for that? That feels like playing poker and the dealer asks you to show everyone your whole cards.
That is exactly what it is. It's a strategic trap. If Union Pacific publicly states, we will walk away if the concessions cost us more than $5 billion, then every opponent of the deal,
The unions, the shippers, the competitors.
they know exactly how hard they have to push to kill the deal. They just have to push the cost to $5.1 billion.
So the STB is handing the opponents a blueprint to kill the merger.
Effectively, yes.
And Vena agreed to provide it?
He did. You could hear the grit in his teeth, but he agreed. He noted he doesn't see how that number affects the merits of the deal, but he knows he has no choice.
Right. If he refuses, the application stays in limbo.
Exactly.
Speaking of opponents, this led to my absolute favorite moment of the call, the coffee shop rant. This was Vena unleashed.
Oh, this was classic.
Vena was addressing the complaints from other railroads, presumably CSX and Canadian National, who are lobbying against the merger. And he used this analogy. He said, I would tell the owner of that coffee shop, your coffee is the best. I'd only complain if the product they had was better than mine.
It's a brilliant rhetorical move. But let's look at the psychology here. Vena is arguing that they're terrified.
Right. He's saying, if this merger was going to make us a bloated, inefficient mess, our competitors would be cheering it on.
Exactly. He's framing the opposition's complaints as proof of Union Pacific's superiority. He's telling investors, look, CSX isn't trying to stop this because it's bad for the country. They are trying to stop it because we're going to be so efficient, we will put them out of business.
If you were selling terrible coffee, I wouldn't try to stop you. I'd just let you go out of business.
It turns the regulatory headwinds into a badge of honor. It's 4D chess.
So the merger is messy but moving. Operations are slick. What does this mean for the listener, the investor, looking at 2026? Because the guidance was, well, muted seems to be the word of the day.
It was realistic, maybe even a bit somber. They are guiding for mid-single-digit EPS growth in 2026. That's solid, but not explosive.
And CapEx is coming down to $3.3 billion, so they're spending less on building the railroad.
It signals capital discipline. They aren't building for a boom that isn't coming. But there was a warning from CFO Jennifer Hammond that stood out to me.
Oh.
It was about the battle between inflation and pricing. And this is where the macro picture gets scary.
Let's unpack that. Because usually the story is simple. Inflation goes up, the railroad raises prices, the railroad makes money.
That's the traditional model. But Hammond said something critical. She mentioned that wages and benefits are pushing their internal inflation to around 4%. And then she admitted, very candidly, that price may not be a driver of improving margins in 2026.
Whoa, stop there. If your costs are going up 4% and you can't raise prices to match it, the math doesn't work. Your margins have to shrink.
Exactly, unless you cut costs. She's saying that the pricing equation might not hold this year. They are losing tailwinds from coal and natural gas surcharges. So the pricing power that railroads are famous for,
It might be evaporating.
it might be.
What does it say about the broader economy, though? If Union Pacific, one of the biggest movers of goods in America, can't raise prices, does that mean the customer is tapped out?
That is the implication. It suggests we are hitting a ceiling on what the industrial economy can absorb. If they raise prices, they lose volume, so they're stuck.
So if price isn't driving margins and inflation is eating 4%, how on earth do they grow earnings?
You have to cut or optimize productivity, running fewer trains, using fewer people.
Ah,
That is why those efficiency stats, the 2-mile trains, the 5% workforce reduction, aren't just vanity metrics. They are the survival strategy.
they aren't doing it because they want to. They're doing it because they have to.
Precisely. If they can't price their way out of inflation, they have to efficiency their way out of it.
So the macro environment is muted. Industrial production is flat. Housing starts are down. They're essentially banking on self-help.
And that is the risk. The JP Morgan view that came out right after the call warned that UNP might underperform if that pricing power doesn't materialize.
If you can't raise prices and you've already cut to the bone, where does the margin come from?
Right. Now, Veren would say it comes from hustling. He talked about finding new business, Mexico grain, petrochemicals. But hustle is great. it doesn't always beat a 4% wage hike across a workforce of 30,000 people.
Okay, so we have a railroad that is running efficiently, fighting regulators, and facing a tough economy where they can't raise prices. It's a complex picture.
It is. But sometimes when you look at a complex picture, you see something opportunistic.
Which brings us to our favorite segment of the deep dive.
The "this is not financial advice" segment?
Disclaimer time.
Yeah.
We're just two voices in your headphones. We're talk tickers, not your financial advisors. Do not trade based on what we say. We're just exploring the edges of the map here.
But if we were a hedge fund analyst pitching a wild idea to the investment committee, what is the trade?
I call this the land baron arbitrage.
Ooh, I like the sound of that.
Remember that 30-cent EPS boost from industrial parked land sales?
I do. It was the only reason they beat the gap number. It saved the quarter.
Here's the pitch. Union Pacific isn't a railroad anymore. It is a distressed real estate liquidation trust disguised as a transportation company. Think about it. The freight recession is real. Volumes are down. Pricing power is evaporating like we just discussed. It is really hard to make money hauling grain right now. But what does Union Pacific have? They have land. Massive amounts of land given to them by the government 150 years ago.
Legacy assets.
Exactly.
Yeah.
Every time earnings look a little soft, what does Vena do? He sells an industrial park in Houston. He sells a slice of the portfolio.
He monetizes the dirt to smooth out the earnings.
Exactly. So the trade is this. You go long UMP, but you hedge it by shorting the IYT, the transportation ETF.
Interesting. So you're betting on Union Pacific specifically against the rest of the transport sector.
You are betting specifically that Jim Vena will continue to monetize that massive land portfolio to manufacture earnings beats, while the rest of the sector, the trucking companies, the other rails who maybe don't have that land bank, gets dragged down by the actual macroeconomy.
So if the freight recession continues, the IYT drops because nobody is shipping anything. But UNP stays flat or goes up because Vena sells another parking lot in Phoenix.
Exactly. If the rails stay flat, Vena sells a rail yard and you print money. You aren't betting on trains. You're betting on the liquidation of 19th century land grants.
That is incredibly cynical. And frankly, considering the 30-cent boost this quarter, entirely plausible. It's basically arbitrage on their balance sheet.
Wild, but plausible. That's the sweet spot.
Just remember, eventually you run out of land to sell. It's a finite resource.
That's a problem for 2028. We're trading 2026.
Fair enough.
So bringing it back to reality, what is the final takeaway here for the listeners?
UNP missed the quarter. There is no sugarcoating that. But they held the line on the narrative. The Vena doctrine of efficiency is keeping the floor high. The stock didn't collapse because investors believe the floor is solid.
Even if the ceiling is currently being lowered by the STB and the macroeconomy.
Exactly. They are controlling what they can control.
But I want to leave the listeners with one thought. If Vena runs out of land to sell, and he squeezes the last ounce of efficiency out of the network, does Union Pacific have a growth story left? Or are they just managing a slow decline?
That is the multi-billion-dollar question.
Keep an eye on those Thursday morning metrics. Let's see if Vena's promise about the winter storm recovery holds water, or ice in this case. Thanks for listening to Talk Tickers.